Sometimes the fear of losing money in a market crash can prevent you from investing altogether. But there's a simple way to overcome that fear, and it's called pound cost averaging. In today's video, we'll be exploring a few options investors have when they're looking to invest, and we'll also be looking to answer the question, when is the best time to invest? For people that have the money to invest, there are broadly three options. Option one, market timing. So this could be where the investor chooses to wait until the market recovers before putting their money in. Now, the problem with this thinking is that once the market does recover and bounce back, you will have missed the gains on the way up. Conversely, if the market continues to fall, how will you know when it bottoms out and buy in? Successful market timing is no easy feat. Peter Lynch, one of the greatest investors in history, explained that far more money has been lost by investors preparing for corrections or anticipating corrections than have been lost from the corrections themselves. Option 2, lump sum investing. Well, this is where an investor chooses to invest, say, £120,000 today in one go. Pretty straightforward. Option 3, pound cost averaging. Or if you're in the States, it's dollar cost averaging. So this strategy is where you drip feed a fixed amount at regular intervals into your portfolio over a period of time. So for example, instead of investing £120,000 in one go today, you're investing, say, £10,000 per month over the course of 12 months. Now, the benefit of doing this is that you will not invest all your money in one go right before a market crash. And as you buy shares in regular intervals, in rising markets you'll be buying less shares, but in falling markets you'll be buying more shares, which sounds quite good, right? Well, the problem with this is that pound cost averaging lowers your expected rate of return. The simple reason for this is that over the course that you are pound cost averaging, you are holding cash. And holding cash means you have a low expected rate of return. Now, there's more to the downside than my simple explanation. In a paper titled A Note on the Suboptimality of Dollar Cost Averaging as an Investment Policy, written by George Constantinides in 1979, I believe, he basically explained that dollar cost averaging or pound cost averaging is suboptimal. Furthermore, Vanguard produced a white paper in 2012 titled Dollar Cost Averaging is Just Taking Risk Later. So in this paper, it analysed and compared dollar cost averaging against lump sum investing across the US, the UK and Australian markets. And what it found was that lump sum investing consistently outperformed dollar cost averaging 2/3 of the time. So your best bet is to use lump sum investment as a strategy because it produces better results. To conclude, market timing is not a good option unless you have a crystal ball. If you have money to invest, you should look to either build a pound cost averaging strategy or invest a lump sum in a risk appropriate portfolio right now. Statistically speaking, lump sum investments will give you the highest expected rate of return. And as long as you can handle the ride, now is the best time to invest.